Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you a strategy I like to use, kind of like similar to a trailing stop, but this is one that we can use to convert an option trade into potentially a free trade or even receive a credit and have potential for a huge payoff into expiration. So last week, this is Boeing. We did a trade setup. This was from a textile trade alert that we have at PowerCycle Trading, and did this alert to buy Boeing right here. This was based on our cycle model, cycle 1 and 2, positive momentum, and everything. The chart pattern looked good for potential push to the upside. So this was set up doing a long call debit spread on the 21st. And then, we didn't know where it was going to go. We had a potential target to right here before that 350 strike, so 345, 350 in that area. But it exploded higher off some positive news, etc. So when it started moving up here to this high, we also saw that there's a big 200-day moving average right here as potential resistance. So we converted the trade from a long call debit spread to what we call a long call condor, and actually turned it into a credit type of spread situation where there was no risk and potential for a huge payoff if we get an expiration this Friday below 355. So let me show you. So the original trade was an alert trade setup that we sent out, and this was to buy the 342.5 call, sell the 345, so for the 30 August expiration. So as long as it expiration this Friday closes above 345, this will be a max profit based on the spread. We bought this for $105. Will be $145. Went out today at 102 because it still has some extrinsic value left in the trade from the time value portion of it, but it should, unless it totally falls apart, it should probably be max profit here. But what we did when it exploded to the upside, like here on this day, the 22nd, we converted the balance of the trade. What you want to do is take profit here, 1/2 your position or 3/4 or something like that. Take your profit when it hits your profit target, and then a lot of different things you could do. You could trail some of your profits, or the other thing you can do is lock it in by converting it to, in this situation, what we call a long call condor. And we did this and locked in a credit by doing it. So you can see here the debit paid was $1.05, and then when this was exploding to the upside on the 22nd, sold the vertical bear call credit spread, the 355.57.5, $2.50 wide for $1.15 credit. All right, so that's the credit side. So now we've got this structure. We've got the debit spread on, and now a credit spread brought in on that $1.15. So this Friday, the 30th, if it just closes inside our short strikes of the 355 from that short strike on the credit spread and the 345 from the short strike on the call debit spread, this trade will make $260. And the risk, there's zero to the downside. Actually, we turned it into a credit. So if it was to crater to the downside, we'd still make $10. If it exploded to the upside, we still make $10. But if it goes out inside of here, we make $260. So a fantastic way to adjust your risk and also to increase your profits.